All right, guys. So I just wanted to quickly go over some possible strategies when to buy to close early. Um, you don't necessarily have to do these. It is a little bit more time consuming to do it. Like if you're more alert with seeing all your positions, you could look into different factors and to try to close them early. But in most cases, and pretty much all the trades that I give, it's perfectly fine to just wait it out and let it expire worthless. Especially if it's like a cash secured put and you want the stock anyway at a lower than the current price, no, there's no reason not to like close that early and just wait it out because you're happy owning the stock anyway and you're getting that initial return that you want, then it's fine, right? So I guess the main factor for buying to close early is, do you want to actually have a new position in play? And do you have enough time and the commitment to actually do this stuff? Because again, it is a little bit more time consuming. I personally check the market pretty frequently throughout the day because obviously you got to help all the members. But obviously, based on your jobs, based on just the time commitment you have, some people might want to be a little bit more like standoffish. Like they'll enter a trade for 30, 45 DTE, and then they place a trade at lunch, and then they wait. And then if it expired and it worked, good. If not, they might just stop out of it. So definitely consider the time factor into these things. Okay. So looking at the trades from 217, we'll look at these spreads here. I just took a screenshot because I'm trying to save my memory. For some reason, my camera keeps cutting off. I have so many things open, so I just took a screenshot of it. These are the 217 expirations for the put credit spreads. And I happen to close pretty much all of them. I think the only one left is IWM, which I could have easily closed if I wanted to. It was around 10 or 11 bucks, I think. It just didn't fill like when I did it this afternoon. So all of these still have 15 days before final expiration date. So a lot of these are at least half the amount of time where it could still go on compared to when we just started the trades. Like we started some in beginning of January. Obviously, these had more time, had about 45 days or so. And then you go down 40, 30s, 20 days. And so what was good about the market going up so fast was even the later ones, like some of these are only about 20 days out, we're still able to close these early at a pretty good profit. So few of the general things here. If you could get more than 50% of your profit in less than 50% of the days in the trade, then your return per day would be more than if you just waited it out, right? So just looking at an example, let's say you take in $25 and it's 30 days out. Just to make the math easier, you take in $30, 30 days out, right? So in effect, you're trying to get $1 a day on that position, right? So if it's, let's say, 10 days in, less than half the time that you're in the trade, and then you could buy to close it for half, say 15 bucks, then you made your $15, right? You took in 30 when you sold it, you're buying it back for 15. So you made $15 on the trade, but if you can make it in 10 days, then you made $1.50 per day. I think the math should be right? So it's a higher amount per day than if you just waited it out the rest of the next 20 days just to get another 15 bucks, right? And that just makes pretty sense in the math perspective of it. But obviously, you want to see when the amount of time is available left in the trade. And then you could also look to buy to close it by setting a limit order if you want. So you can make it a little bit more set it and forget it. Like this Apple trade was a month and 12 days, so 42 days out or so. Taking $23, you can maybe make a buy to close at 10 bucks and then leave it as a limit order, good till canceled. If it happens to close in about 15 or less days, then you're happy with it. You got your turn. That's good per day, a little bit higher than the beginning trade. And then you can just move on, you get more buying power, you can cycle into new trades.
Hey, Lance,
Does that make sense, guys?
it does.
Any
Uh,
questions?
yeah. So, none of these appear to have been threatened.
HD was the only one. Sorry, Vandal, on that one. Those that rogue weird day where the market did weird stuff. But yeah, HD was down about $30, $40 at one point, but the rest weren't challenged.
And that
Uh,
UPS one that killed me, the glitch in the market. I think it was UPS.
Or UPS too, yeah.
but when you get close to expiration, you run the risk of, because gamma's going up as you get closer to expiration.
Yeah.
So your delta's gonna move a lot faster.
Yeah.
Yeah, I've always been in the habit of closing early because your price can, on the option, can move around a lot as you're coming up, inside of a week.
Yeah.
What are your thoughts on that in terms of the risk of,
Yeah, that's a good question.
a gamma squeeze?
Right. And that's a good point. I usually tend to buy to close at $5 in a lot of cases. And if you look at the 2022 log, I usually set a cancel limit order at $5 because at that point, sometimes the options are free and commissions. By the way, think or swim, the option itself has to be 0.05 or less, not the spread width. So if you're closing both of them at 0.05, that doesn't necessarily mean the commissions are free. But if one of the two options or both of them happen to be 0.05 or less, then the commissions are free. So that's not really too much of a factor in the end. If it's way out and the delta's lower than you started it at, and obviously these deltas are really low to begin with, 0.08, 0.12. If the delta's 0.03, 0.05 with a week left, I usually just let it go and let it expire worthless.
That's a good point.
But if the delta's already higher, like 0.2, 0.3, and you could happen to close it even at a slight profit, because that could still happen with a week left, then take the risk off the table. I mean, you won't make too much, but at least you get the risk off.
At what point would you?
I'm a little bit more loose on that, where if the delta is 0.3 or so, and it didn't hit the alert price yet, I'm still gonna wait it out. And then if it happens to touch alert price, even with a week left, I still may not close it out because these
Okay.
alert prices are usually 3-4% out of the money anyway. I'll just keep a closer eye on it, but that is more time intensive, obviously.
Yeah. You know what, that's a really good point of just monitoring where the current delta's at as you're getting closer on time.
Yeah.
That's a really good point.
Yeah, obviously, like if it's close and it might be near a stop out, you probably just want to close it. I think PG had that for January where earnings were coming up and it was already a relatively high delta. So I recommended to close it at, it was like a $4 or $5 loss at the end. It wasn't that much. Just because you didn't want the earnings and the gamma to hit you.
Good point.
And a lot, I mean, you guys might have bigger accounts, but with me, a lot of the time I close it 0.08, 0.07. One, it's easier to fill for me. But two, I'm freeing up capital. If you only have a $5,000-$6,000 account, I can get that next day's trade, which I haven't really had an issue yet because the market's been pretty good and they've been closing pretty quick. But I think that's another consideration for a lot of people is if you need the free up capital for that next day, which one can I get for a pretty good price?
Yeah, that's true. For a lot of these trades that were the 217, I'm personally leaving a lot in cash in my brokerage just so I could do at least one contract of every position.
Yeah.
But if you are a little bit more active on it and you're only leaving maybe 2-3,000 total in your account when you're near that expiration cycle, and then you want to cycle in more trades for that current expiration, that's actually a good strategy to do. It's almost a little bit like the sweat equity too. Like if you buy a rundown house and you know how to fix houses up and you manual labor and literally start knocking down walls on your own and stuff, you could theoretically make a much bigger return than if you just had a property manager do it, right? Because you have to pay them. So it's a similar idea of these trades. Like if you have the time for it and you're willing to look a little bit more into the trades and able to manage those as well, your return might be slightly higher in the end by doing all that stuff. So it's a similar analogy to that, just like in a different field, obviously. Hey, all right, how are you? You can unmute your mic if you want.
How often, I was going to ask, and it might be a little off task, but how often does when does the alert for the stock coincide with the 3 times stop?
Yeah.
At what point does that coincide, or is it about, or I know there's not a particular time, but obviously if it was turn right away, the stop would hit before the alert.
Right. Yeah, exactly right. I try to make alert prices that are still a little bit out of the money because it won't be at max loss scenario. And obviously, if it did that right away, you're still not at a max loss because you still have time on your side. So you would be a little more than 3x stop, but you could still at least not lose a full 500 at that point. I try to make alert prices where, like, obviously it's a guessing game in the future because I don't know what's going to happen with the stock and when it's going to move up or down. But in most cases, if it drops to that alert price in around half the trading time, so if it's a 30-day out trade and 15 days out, it hits alert, that's usually very close to a 3x stop in most cases. Now, obviously, there's a lot of factors at play. Implied volatility could go up too, and that would make the options more valuable, which actually hurts us. If implied volatility drops a lot, even if it hit the alert price, you still might be close to break even in the end. So there's obviously the time of when it hits the alert, implied volatility are the two main factors for that. If there happens to be earnings and the earnings just got released, the IV would drop significantly right after that. So even if you happen to be in the trade and it hit the alert price, but you're still a few percent out of the money, you might still be okay and you might just wait it out. Like I've had some trades a few months ago that came very close to touching or did touch the alert price, but I didn't stop out of it. Like I just waited it out a little bit, and most of them ended up being fine. Like obviously it won't always work that way. It could easily drop more, and then I'm just being a little bit more hawkeye on those to make sure that I could get out quick if I needed to. But other than that, like I'm trying to make it where it's reasonable for a lot of members to see if the alert price gets touched. Then if they want to be conservative about it, you can just stop out, move on. It's probably not a huge loss unless you're right if it happens like right away.
Yeah.
Yeah, obviously if it drops a ton, like HD got pretty close, I think, to touching alert. I don't know if it actually hit it though.
I don't
The
think-
alert was still on, but besides that rogue weird 10-minute candle or whatever it was, like I don't think it actually touched the alert after that. Good questions though. Anyone else or Eric, do you have any questions over there? We'll leave it open for Q&A and the rest of the meeting here if you like, if you guys want.
Lance, when it comes to buying power, I've always used a rule of thumb of using a percentage of total buying power.
Okay.
Is there one that you like to stick with as opposed that you use as kind of a rule of thumb as opposed to, I've got 10 grand each trade is $500 per contract of risk. So we're going to have this many trades, and where you literally taking it up to the max.
Yeah.
Or are you gonna, is it your preference to do a percentage of that total?
Good question. For futures trades, I very frequently say how much buying power I have left and what the total account size is. So I don't want to go more than 50% in that regard, because obviously if it keeps going against you, it could really hurt in your buying power. And I like to stay around 40% in most cases. For the test group put credit spreads, I usually try to put quite a bit of funds in to as many positions as I can. When I first started Data Traders, I would do about 95% of my positions that I could. So if I had a $10,000 account, I'm putting $9,500 into it and just recycling into more trades. But I didn't take every trade back then just because I wanted to make sure that my position sizing was adequate. If I have a $10,000 account, I'd probably do 10 total trades. That makes 2 contracts of a 5 with, and then I'm good with the 10 grand or so. So then I would try to hit that as soon as I could reasonably, and then just wait it out and not take the other trades. Now I'm just more of a, I guess you could say, like, observer on these. Like I want to make sure I'm doing at least one contract in every quick credit spread, just so I could be aware of more how I could alert others, like what I'm doing with it, so that I could help you guys understand what to do as well. I currently have a lot in cash for my credit spreads because I want to have enough cash available to take every trade. So it's a little bit different with that. Obviously you can make a bigger overall return if you're using most of your percent of your buying power, like at most times. I know some aspects, some people like to wait and leave a decent amount of cash on the sidelines, knowing if, say, the market drops a certain percent, then they're going to use more of their funds because there might be better deals out there and then they can take more trades at that point. So there's definitely different avenues you could go with that. But with me, I'm personally leaving quite a bit in cash just because I want to take all the trades.
And you do a lot of this in your Roth, right?
I do the cash secured puts and like more conservative, buy and sell a covered call. I do most of that in the Roth IRA. I'll do about 30 to 40% of the cash secured puts as well of all the alerts. I'm not doing every single cash secured put.
Okay.
Questions? Ultra's in. Hey Ultra, how are you? James,
Hello.
right? We're just here for Q and A. If you have any general questions, and you can rewatch the recording. I went over the reasons why we might want to buy the close early on some trades.
So do you put call credit spreads on occasionally?
Almost.
I know if you did that these past 2 weeks, like I did, you just get run over.
Yeah. I'm more like very long-term bullish, just believe in American capitalism and how over time positions will increase. So that's why I look in the put credit spread side, and I think I'm doing pretty decent at finding opportunities where it gets a good amount of credit for just one leg and not going to call credit spread two and making it an iron condor. I know in the beginning of last year I did a few call credit spreads that worked okay. And I was also trying to manage some where if they got near the alert price, I would then sell a call credit spread, taking more income, the same amount of funds. It didn't really seem to help in the end. Like even though the market dropped, I kept dropping more and more in the beginning of last year, and the call side didn't really help. You get a few extra bucks on the call side, but you still might stop out anyway.
Yeah, it's run me over because I'd put a spot put credit spread on, and then on a pretty significant up day, it's like, okay, I'll do the same expiration and go out, and I mean these 3 sigma moves are just brutal.
Yeah. The market jumped a lot the last month.
Nature of the beast, I guess.
Yeah. It's also a possible greed standpoint, even though you might not necessarily be taking the trade based on that, but it is very tempting to know that you could do a call credit spread too, not use any extra buying power, and maybe take in an extra few percent on your trade. And also, like, yeah, if you see a few big up days, you probably think it's not going to continue doing a lot of up days. So call credit spread could make sense to do it that way, just based on mean reversion standpoint, like the trade will probably go back now. So you could consider doing some. I don't think there's necessarily wrong with that. You may not want to do a ton of them though.
Yeah, like I said, I've gotten burned on a few, so I may just slow it down.
Yeah,
But these moves they're not typical.
it's not. You're right. Let me see what I don't know in the last few weeks. It's been really big jumps. Looking like the 3 month chart, we went from SPX went from 39.10 on January 20th to 41.95 for the high. That's a huge jump. It's almost 300 points in what 12 days. Phew. It's pretty atypical to see that.
Yeah, and today you saw the VIX popping towards the end of the day while the market was still going up.
Yeah, which doesn't happen much.
Yeah, well, that also means perhaps retracement. At least I think.
Perhaps.
What do you think of I take all of them just because I told myself I was gonna do that this year on the put credit spreads, but what do you think of Meta? It did worry me a little day when I seen you Meta was your pick today or your alert, and man, I just will it bounce back down and retrace a ton since it went up 20% today?
Of course it might, and it probably is gonna have a down day tomorrow, I'm guessing, based on the other tech earnings.
Yeah.
It's pretty, I don't do those trades that much, but it shot up so much. It was up 23%. It was up even more than that at one point.
Yeah.
So I thought the strike is still fair, so that's why I took it, but it's not a very common way that I go on it. It's just that the premiums were still pretty high. It was still really far out. Like we went 155, 150. Let me share my screen real quick. I'll explain why I went over it. But yeah, so we did 155, 150 on that. And then let me move that. This is a daily chart.
Yeah,
I mean, that's a huge gap, yes. 155 is near the high of the day before. It's just still a big jump. I don't remember let me see what the exact price was when I made the alert. It was at 193. So 193 minus 155 of my sold. So it's a difference of 38 points divided by the price at the time, 193. It could drop 19% before it touches in the money. And
Yeah.
it just released earnings. So there's not gonna be another earnings for 45 days or 40 days, whatever it is. So I thought just based on it being really far out of the money, I paid more than 25 bucks, I took it.
Lance, did the vol crush, as part of that?
I mean, the
well.
premiums were still high though, because I took in, $30 on it. And it was a 0.07 delta. So yeah, there
Yeah.
was some IV crush, but that's still a pretty good payout for, 20% out of the money.
Yeah, well, yeah, you're kind of hitting my point is that, the premium that received was so significant that you probably see volatility continue to come down potentially.
It might. I mean, with the tech tech sector, with possible bad earnings in a few big companies tonight, IV might go up because of that. It's hard to say. We can look at implied volatility. That's one of the indicators, by the way. I think it's IV. They keep typing it different ways. Remember, TradingView says it different for IV. Forgot where it is. Volatility. So look at one thing I was trying to test out is looking at historical volatility, comparing it to implied volatility, and seeing if there's a big difference there. So if you have high implied volatility and low historical, that's usually a good time to sell puts, especially because there's a good chance that implied volatility is actually more. But if it's the opposite, which it is flipping as you can see just today, historical volatility went up a bit and implied went down. That's not good for us. However, we're so far out of the money, I'm not gonna worry too much yet. It's
Yeah.
down about 3 points after hours. But yeah, in order to like place trades, for instance, right here, historical volatility was pretty high. Implied volatility is pretty low. That's usually when you don't want to take a trade, because if the volatility is amplified a bit, that means that there's a lot of variation at that actual stock price compared to what the premium's collecting here. So you want a big difference between the two. And right before earnings, it was actually possibly a good time. Because
Yeah.
the volatility was high, but historical was showing that it's not as bad as it seems. Obviously, if you took a trade here, you would have had to take the trade into earnings though, which is another factor. You can see the IV crush happening here. So yeah, personally, I don't mind necessarily taking trades into earnings. I just don't do a lot of them. But it's hard, especially around the last few weeks where so many big companies were giving earnings anyway. It's hard to find positions where you want to take trades because like I'm used to like the same about 30, 40 stocks.
Yeah, and the all-time high. I'm just looking at the chart right now. The all-time high is double what the current price is.
Oh, yeah.
Yeah. I might still have room to move up. But what's good about these is we have a huge cushion, so if
Yeah.
it stays where it is, we're perfectly fine. If it moves up, we'll close it early. If it goes down a little bit, even 5-10%, we're still probably okay. Usually don't see that big drop of 20% difference in what the current price is to what your strike price is, and like a relatively lower IV stock compared to like some of the cash puts I do. Because usually the cash puts have higher IV in general. Good questions. We got about 7 more minutes if anyone else has anything else to add or mention there. I don't know who iPhone is. Is that Jimmy? Might be Jimmy in the iPhone. 'Cause I think he doesn't change his name.
Yeah, that's me.
There you go. See, I know some people's names. There's a lot of
You
people.
did.
It's hard to remember everyone's name, but I knew you were iPhone.
It's only taken 8 months to get from JWS to Jimmy, so I'll take it.
There you go. See? Oh yeah, I knew the name. Because when people sign up for Discord, I don't see your name.
Yeah, I
Like,
don't know what I'm doing.
I see your Discord name and I'm like, hi. And then some people like say their name, like I should know who you are. And I'm not trying to be rude. I already have 100 students and I barely know their names, but it took me like 6 months. So some people that sign up, they're like,
Yeah.
how do you not know my name yet? Like, guys,
No worries.
I don't see your name when you sign up. I just see your email. But some people's emails don't have their name on it. You have any
No
questions?
hard
Jimmy?
feelings. No, I was just jumping to say, hey,
All right. How's your thoughts on using premiums to buy shares of stock? It's a good long-term strategy, I think.
I like it. Like I said, I'm just getting stuck. I was tunnel vision on 2 stocks, so I guess I'm just going to do that and build them up for a little bit.
Yeah.
Um,
What
obviously,
lower price stocks are you thinking for doing that?
well, I'm doing, like I said, Region Finance or RF, Regions
Yeah.
Financial, and AT&T, because they're both about 20, and our put credit spreads are around 20
Yeah.
premium there. I also, just for the fun of it, for some that I know I may close early, I'm doing I did a AGNC. It's just a monthly REIT.
Okay.
It's not a steady one, but it's a monthly REIT for a while. So I did that, but I'm mainly focused on the other 2.
So
I also thought about
for those of you guys that don't really know what Jimmy's doing, he's taking his premiums that he collects from a trade and then using those premiums to buy stock with it. So it looks quote unquote free because you're using those premiums to buy those shares. And if the trade happens to work, then in a way that particular stock was free, right?
Yeah,
Did I
so
summarize that pretty much how you're thinking about it?
yeah, that's why on some in my Roth, when I'm doing with the cash secured puts, I'm doing only 50%. So just to be safe. But I mean, worst case scenario, you pay half the price for a stock.
Right.
Um,
Psychologically, it feels good knowing that you're buying shares that came from initial positions you had.
I'm doing this for a little bit. I'm going to build those 2 up. Then I was thinking maybe in a month or 2, maybe just wait like till the end of the month, or maybe each week buy a stock, so buy a little bigger one.
Yeah.
You know, if you get into $20 a day in the cash or in the put credit spreads, but I can't talk. Put credit spreads.
Yeah.
Then you have $100 you could buy a stock with. So
Yeah, you can wait it out. There's no reason, no rush for it. Unfortunately, Thinkorswim doesn't do fractional shares. That'd be pretty neat. You know,
yeah.
we use M1 Finance for my daughter's like picks, so they could buy like 0.1 shares of stuff because you only need say 10, 20 bucks depending on the share price.
Okay.
But yeah, just leaving it in cash is fine too. At least you're getting a little bit decent money market rates now. It won't be a ton, but get a few extra pennies while you wait to build it up a little bit to buy $100 stock.
Yeah.
Yeah, so that's I said you told me RQI was a good one to do.
Yeah, it's relatively cheap too. I think it's like $12 or $13 a share. It pays good dividends.
The problem is I can't do that with Robinhood because it doesn't work there. They don't allow that. So I'm trying to do more just in the Roth, but I said when I get the credit spread premiums, I got to do something there with it.
Right. Brad, you had a quick question there?
I just a comment. I really appreciated the new idea, and maybe it wasn't a new idea for you, but you put forth last week with the 1-1-2 ratio spread.
Yeah,
You know, and it just strikes me that, you know, structuring like that is where edge really starts to come in with options trading quite a bit.
yeah, and the flexibility of it.
Yeah, and like for example, like one thing I thought about with Meta, and I couldn't do it just because I had meetings with clients today, but like doing a similar type of ratio spread just to push your break even
Yeah.
way down, because it's such a you know, it's such a high volatility stock that, you know, that puts an even larger safety factor on that.
Yeah,
But like those different types of ideas I really appreciate, because candidly, you know, that's you know, that's where I have really come to appreciate this group, and you, Lance, in particular, just to help me kind of think more about
oh yeah,
different ways to either increase profit or probably just as importantly decrease risk.
yeah, yeah, they're probably decreased risk might be more. We got like 2 minutes left, so let's summarize it out. I have a lot of ideas in my head and they constantly pop up, and sometimes I might mention it in the Lance's workshop channel. Just to say, like, I might be considering this new strategy. And I have to keep a fine balance here, because if I do
Sure.
many different strategies with all this, like, people can get overwhelmed, especially beginners out there. So I kind of leave that for more for the yearly lifetimes. I think everyone in here might be yearly or lifetime. I know Ultra's thinking about it. We'll get you set up if you want.
Yeah,
So,
I'll be yearly in a few weeks.
all right, sounds good. Yeah, so like I constantly have thoughts in my head, and that's kind of like my little tinkering workshop place to consider these new ideas. Like, you could do a lot of options and a lot more than what I'm even sharing, but you know, stuff will pop in my head. Maybe I'll test it out and see, and then maybe it'll eventually be alerts. So yeah, guess we gotta close that up. So appreciate everyone from joining here. And we did update the website, by the way, and Josh helped greatly on doing that. So if you
It looked
wanna-
nice.
yeah, it looks good. So
Yeah.
check that out. And all you guys are almost all yearly, and Ultra, you'll like this. Next week we're gonna give out Inner Circle for free for everybody for a week, just so everyone can check it out. So I'm essentially gonna post for everybody in one channel and then just get rid of the channel. So take a look out for that. And thanks a lot, guys. I'll see you guys next time.
Appreciate it.
All right.
Thank you.
Thanks, Lance.
No problem, guys. Have a good night.
You too.